In his keynote speech, Nvidia CEO Jensen Huang was optimistic about the path forward for AI and the billions earmarked for its build-out.
So in just 1 year, and Blackwell has just started shipping, in just 1 year, you could see the incredible growth in AI infrastructure. Well, that's being reflected in computing across the board. I've said before that I expect data center build-out to reach $1 trillion, and I am fairly certain we're going to reach that very soon.
The announcements, however, initially not met with much enthusiasm from investors. The stock closing nearly 3.5% lower on Tuesday, though recovering a bit in pre-market, up about 1.5%. We've got Pierre Ferragu, New Street Research Managing Director, here with us for more. Pierre, great to speak with you. Obviously, Nvidia not impressing investors off the back of day one at GTC. Did Jensen impress you? Were you buying the GTC dip yesterday?
Yes, I think Jensen did a very good job, articulated well the position where AI is today and what the outlook for AI looks like today. And this outlook is changing a lot and very fast and is very uncertain, so that's not an easy job. He highlighted very well that the scaling laws are still present, growing the size of models, growing the amount of compute you put into pre-training, into post-training, into inference, even now, is still very, very, very vivid. And most importantly, he showed how much, his product roadmap is matching that with larger and larger GPUs, an accelerated cadence of new GPUs coming to the market, B300 at the end of the year, and Rubin next year, and the next gigantic flavor of Rubin in 2027. And of course, like the commercial momentum, they have this slide where he shows that the top 4 cloud service providers are going to buy like more than twice, almost 3 times the number of GPUs they bought last year. And GPUs that cost significantly more, that are significantly more powerful, are really a testament of the fact that scaling laws are still present. And so the AI infrastructure market is still growing.
Pierre, I wonder how you're evaluating the stock reaction, though, here over the past few months, especially after some of the all-time highs of the beginning of the year. The company has essentially been in this channel kind of lower. And with that, it's really raised the questions of how long it's going to take for companies, including Nvidia, to grow into these lofty AI valuations.
Yeah, no, it's a very good point. And I think to understand the stock today, you need to go back to the Black Monday, to when the market reacted very negatively to the research DeepSeek published and the new R1 models they released. So on that Monday, these stocks were down in the 20% region because investors got scared by this idea that AI could work with way, way less compute, and that it's like a natural initial reaction to think it's bad for people selling compute. But it took 24 hours to the market to realize that was the wrong way to look at it. The stocks came back very significantly the following day, on the Tuesday. But after that, what happened that these stocks became very weak, got more volatile, and actually drifted down. And to me, in my conversations with investors, what very clearly popped out is the fact that investors started pricing in the fact that being invested into AI is also being invested into the unknown. Even if DeepSeek was in the end not a significant piece of news, was a very natural thing to happen in the industry, that what happens at DeepSeek happens actually everywhere else. But investors realized, knowing what AI looks like after 2025 is actually very difficult. What AI is going to look like at the end of the decade, in the next decade, is actually very difficult. It's a very open-ended game. And basically that's a risk that got priced in recently. And that's the reason why the stocks are now very cautious. So while Jensen was reiterating all these principles, all these very healthy fundamentals in the market for him, why, it's even clearer today that 2025 is going to be a very good year, that 2026 is already shaping up as a very, very good year for Nvidia. The reality is that investors are talking about open source and how do players investing in AI infrastructure make money in an open source world. Investors talk about, okay, maybe DeepSeek is not going to mean we need to buy less compute, but DeepSeek means we're not going to be able to make money out of the compute we buy. People are wondering about, okay, maybe 2026, the outlook is getting better, but what about 2027? And so this anxiety is still very present. And that's the reason why the stock, in the absence of any significant breakthrough news, nothing was unexpected, I would say, in what was announced today. The stock kind of sold the news, and you see that today the reaction is a bit more positive. So hopefully sentiment from there is going to improve, because at the end of the day, the news flow at GTC is quite positive. So
yeah, I basically hear you saying, Pierre, that the fundamental story for Nvidia hasn't changed. There was just some pessimism after DeepSeek that we're still trying to get over. I want to switch gears and talk about another stock we're seeing a lot of pessimism around, and that is Tesla, down over 35% year to date so far, recovering a bit this morning. I'm curious, you've got a buy rating on the stock. How long does Elon have before the break that we've seen impacting Tesla and the stock in particular year to date starts to be too far gone and unrecoverable?
Yeah, nothing is ever unrecoverable, right? If Tesla sells billions of robotaxi rides, if not hundreds of billions of robotaxi rides at the end of the decade, and sells humanoid robots, millions of humanoid robots, I'm pretty sure the stock will recover very significantly. I think what's happening today on Tesla is a combination of three things. So the first one is that we've had this amazing progress in FSD technology, and the step up that V13 was, that really convinced investors that the robotaxi opportunity, which is still kind of like a moonshot, got much, much, much closer. Then we got Elon Musk getting involved with President Trump into the election, on the back of the election, and into the inauguration, that initially was perceived very positively. Okay, so these two things took the stock into a very, very, very forward-looking kind of place, where it was trading on 100 times an optimistic earnings number for next year. So the stock was really valuing the 10-year outlook of Tesla very, very significantly. And then suddenly what we realized is that the involvement of Elon Musk in politics becomes actually potentially a negative, because we see orders for cars are plummeting. People are getting upset at him. People are setting Tesla cars on fire. It's not good. It's it's nerve-wracking, as an investor told me last night. And then so that's really what's happening at the moment. And then investors wake up and are like, well, yeah, these humanoid robots and robotaxi opportunity they are still there. They are years out.
Right.
They are worth a lot. But in the meantime, things don't look that good. And then the third element that gets into the story is that the beginning of the year for Tesla has been very, very bad in terms of orders, especially in Europe. And it's too early to know exactly why. And there is an element of Elon's visibility has a negative impact on demand. There is also an element of the backdrop of consumer demand in the high end for premium product is not good.
Yeah.
And we know that in the premium car market, January and February can be very, very painful months if consumer confidence is low.
Certainly.
So we need to get out of that, understand what's going to happen, and then probably the stock will recover. And it might take time before it gets back to this last peak, because the last peak was really pricing in many, many years of successful developments on the robotaxi and humanoid robot fronts.
Pierre, we're going to have to leave the conversation there. Thanks so much for taking the time here with us this morning.